we've just gone through a period where everybody was most people were price takers, and I think you need to be a price maker. I think the era of like the rolling funds and really small first time funds, in a non-ZERP world is going to be very tough because most of the small funds, and you're seeing this, they're price takers. Unless you truly understand how pricing works, if you're a price taker, it's just what value where you're truly offering your LPs. You really have to set price and have the ability to, get as much as you can early.
Today we had Howard Lindzon on the pod. Howard has more than 20 years of experience in the financial community, acting in both as an entrepreneur and investing capacity. As an entrepreneur, he founded Stocktwits. As an investor, he founded Social Leverage. And now as an LP, he recently founded Social Leverage Access Fund, a fund of funds that backs emerging fund managers. During our conversation, we covered various topics, starting from the founding story of Social Leverage Access Fund. What is Social Leverage Access Fund? Why investing in emerging fund manager is the right approach? How does he evaluate fund managers? Mistakes fund managers make? 3 pieces of advice he would give to fund managers that will help them become better fund managers, and much more. Now I bring you Howard Lindzon. Howard, welcome to the show.
Right, but
Howie, a good starting point could be, you raised your first fund in 2008, and you're on to your fourth fund, I guess. And then last year, you launched Social Leverage Access Fund. What's the founding story of Social Leverage Access Fund, and why Leverage Access Fund?
in the social leverage active fund came about for a few reasons. First was when we started we started out our first actual fund, 2 and 20, was 2013, 2014. Before that, we were just investing off with our own money in SPVs before SPVs were a thing. I don't even know if they were called SPVs, but 2007, 8, 9, 10, 11. But just investing our own money. And we had copied kind of a beta works model where we were like investing kind of as an LLC. Not a good idea. All kinds of tax issues, etc. Good intentions, not a good idea. That was a thing for a while. The studio model, definitely a tough. I don't think there's anything good in the studio model. Really, investing should be like 2 and 20. Pay for expertise. But the idea of the emerging manager fund was just everything we learned from building our own emerging manager fund, all the things we got mad about, all the things, that we felt our LPs couldn't do. See both sides of the tables type stuff. We thought, and our own money, right? Like as we get older, I'm 58, so when we started doing this, I was 57. I'm like, okay, like I can't not, I've got my one trick, which was, I wanted to invest in the next E-Trade, CNBC, Bloomberg type things. Cause, so I'd already kind of done that trick, and so in putting the ego aside, it's like, okay, what if we could pick, instead of 20 companies, pick 20 managers, pay the extra fees, pay for the expertise, and just be an LP that could be the LP that we kind of wanted, right? And then the other thing was be able to look through to these managers and help them raise cap. Talk to the manager and see what their favorite idea was that maybe wasn't seen by all their LPs, and be able to step in and kind of lead that. We had this experience with Robinhood 2014-ish where we were super bullish because, my insights from Twitter and Stocktwits. And when I saw Robinhood, no one really believed. So even though we wrote the check, like our LPs were like, nah, this is stupid. And then when we had a chance to do all our pro ratas, we couldn't. The one deal we really were begging people to do, we couldn't get people. It's a military plane going by. We couldn't get our LPs to do it. So we thought, if we're going to be an emerging manager fund, we want to talk to the managers and hold our nose and kind of trust them when they had like super conviction. We weren't looking for social conviction. We wanted to bet on managers when they felt something that no one else saw. So that's kind of the idea, aging out, expanding our knowledge base, using our network, not worrying so much about the fees, even though fees do matter, and more focused on like, if we could find 19 or 20 managers that each find one or two great companies, the returns will still be good, diluted down a little bit by fees, but like good venture returns, if we find 2 or 3 or 4 great managers, it's good returns. So that was the idea.
Got it. You said 48?
48 what?
Your age?
58.
Got it.
48 in, I don't know, in some currency, but no, 58, unfortunately.
So yeah, it seems like it was a natural transition for you and others at Social Leverage. Howard, what's the portfolio construction look like for Social Leverage Access Fund?
For the Access Fund, we ended up with 19 managers, which I think, probably 400 to 500 companies. So it's really diversified. Hopefully we can find 5 or 6 companies that we really, really could step into with expertise, especially now that the A world has dried up. Part of our thesis was, we're probably going to be, you can't time the markets, but we were more betting on the fact that that this market wouldn't continue and that we could use our network later. So we'll see, it's never fun when the market dries up, but that was kind of our bet, that the market would dry up and we could use our network and SPVs later when the SPVs weren't cool to like find the next Robin Hood that was emerging. So we wanted to pick more managers. It was very tough time to raise. It's just, we just closed the fund, but it was not a pleasant, year raising capital for anybody. Even with our track record, it was like kind of like putting a sticker on your head saying dummy. No one wanted to invest in funds, let alone a fund of funds over the last year. So timing wise, like anything else, it's just not a good time to be doing what we're doing. Which I think is a signal, like being so hard, I think it's probably a signal that it was probably the best time in the last 10 years to be begging for money. No one wanted to give it. And the worst time was probably 2018 to 2022, when it was just like, other than a few months, the first few months of COVID, it was like easy to raise money. So I think, it's hard. You have to use that as kind of the signal when you have to fade yourself. When it's really easy to raise money, you should remember that it's not you that's a genius. It could just be money's easy to raise, and you should be careful. And when it's really hard to raise money and money's tight, and you're good at what you're doing, can't be mad. It's probably a good time to be investing, and you have to just invest accordingly.
So the fund is mostly focused on investing in emerging fund managers. Howard, why emerging fund managers?
Well, we were one. So we're biased. And I think most of the data says that, first, second, third time managers do the best. And I agree. Like, it's just, your network are strongest when you're starting out, forgetting potential for fraud or just picking bias. You're going to back people within your strong network, and people starting out are more likely to, they may not know enough. They don't know what they don't know, but they're going to be just a little more, they're going to be, like I said, they're not as polished, but they have that that strong network from wherever they just left. And there's something just kind of like like founders. They just have something to prove. And there's that special kind of insights that they have. And the data is the data, like emerging managers have done better.
Got it. So one data meaning emerging fund managers typically outfront perform any other investors in the ecosystem. Secondly, the networks are fresh and they're just going to hustle because it's something new. It's going to give them a lot of energy. And
And
Howard,
we have domain experience. I mean, we were one. So
yeah,
we have that domain experience and bias, I guess, but we think it's all positive.
got it. And what's your selection criteria? How do you evaluate fund manager? Here are a few things that indicates that these fund managers would be or become solid fund managers.
Yeah, we're not so much in the science of that and the data. We're more gut feel. So I think it's like being a seed investor. A lot you just don't have all the data. Like you could. One of the things that bugged us about being an emerging manager, we just didn't check all the boxes for the big funds, and then it's just like it's catch 22. Like if you can't check the boxes, it's just the whole thing's broken. The institutional at some level is broken. You just see that all through life, but it is the system, and that's how the game played. So we don't want to like be too formal about it. So we thought part of our style is not over analyzing, which is good and bad. Like you're going to make mistakes, but for us, it was generally have we worked with the person? Have they had their own startup or operated their own startup? Were they in corp dev? We generally are biased towards people who had their own startup, people that we've worked with that had exits, strong exits, high integrity, deep domain experience, and kind of invested before. I think the biggest mistakes we'll have made, plus the biggest upsides will be from those same group, is just people who don't have experience because they don't know what they don't know, and that could be great. But I worry that in the end, it helps to have been an investor and seen cycles because we've just gone through a period where everybody was most people were price takers, and I think you need to be a price maker. So I think the era of like the rolling funds and really small first time funds, in a non-ZERP world is going to be very tough because most of the small funds, and you're seeing this, they're price takers. And unless you truly understand how pricing works, if you're a price taker, it's just what value are you truly offering your LPs? You really have to set price and have the ability to get as much as you can early, in my opinion, especially in a non-zero interest rate world, to get good returns or market beating returns. So I think that's kind of the problem going on right now, is that unwinding.
Got it. So, people that you've worked with previously, folks who have founded companies, they're operators, founders, or they have deep domain expertise, or they have network, and that triggers you guys to invest. Howard, what check sizes do you write? And also, like is there a criteria? Okay, this is what the fund size should be of fund manager. This is where we're gonna come in. Are we gonna invest in only fund one, fund two, fund three, or starting from fund two, fund three? It's dynamic.
I think we did only fund ones and fund twos, and it was generally 10 to 100 million, and I think we broke our rules for like one or two funds below 10 or above 10. So above 100. So, but we were shooting for 10 to 100. I think in a perfect world, they would be knowing what we know today in this market. I think you got to be probably 15 to 80, or 15 to 100 would be kind of the sweet spot, I think. Just because I think he should be big enough to be able to lead a few rounds, or if not all the rounds, and not so big that it gets hard to return the fund off any one or two investments.
Got it. And Howard, you've been yourself fund manager. Now you are backing emerging fund managers. What's the common mistakes that you see when fund managers pitches you?
We just didn't see that many because even though we saw a ton of them, we didn't take a lot of calls. We just had such a strong inbound and relationships with so many founders who wanted to do this. And being investors in AngelList and seeing rolling funds and backing guys like you with their personal money. I don't think it was the biggest mistake. We kind of knew what we were looking for. I think all the mistakes were made on our end. We made more mistakes than the people pitching us, because again, we're more art than science. We were learning. We didn't want to like overthink things. Like if we liked the people and we knew they had high integrity, I mean, we'll help you, and the software exists. So I think the biggest mistake it's not the people pitching us, it's our own picking. There's no mistake in pitching. If you're smart enough to put together a fund and get in front of us, we didn't see many mistakes. I think the mistakes were just market mistakes. We're going to look back and there was just too much money, and there's only so many great companies and founders and COOs and operators, and everybody was ahead of themselves. There's not enough people in the system to run all the companies that were funded.
Got it. And how we're talking about, mistakes and learnings, what's one thing that now you wish you knew earlier?
Respecting my own, like operating or investing?
Investing from fund of funds.
Oh, fund. Well, we don't. It's so early. Yeah, it's a good question. I think we would have been more at the beginning. We were thinking, well, we shouldn't. I think we were too friendly. I think we're pretty friendly investors, not sharp elbows. And I think for our expertise, we probably could have asked for more for being involved. So that would be the mistake, is just being too nice. I think this is not a business to be nice. I think this is a business and there are rules. And I think when you can always be a little tougher and demand more from people. And the best time to demand more is when you're committing and doing all that stuff. So I think like everybody in this era is just a little too friendly the last 10 years. And, I think in the end, investing is it's hard to beat the markets. And I think we've learned from the best investors of the world, they're not nice people. There's no Mr. Nice Guy. So I think those are the things you learn. If you have to have some sharp elbows, and I think Fred Wilson said, no conflict, no interest. I think sad, but true. I think conflicts are important and everybody has them. So in that world, you have to be a little tougher.
Got it. And Howard, if there are 3 pieces of advice you could give to an emerging fund manager, what would that be?
I think it's going to be a grind. We did it. I got into it because I was passionate. You got the timing right, and the markets were good. You had this massive organic growth coming from Web 2, and after 08 crisis, even though it was scary, you had the Fed kind of behind you. You had the combination of the market crashing, so resetting. You had the Fed tailwinds, and then you also had this incredible tech explosion, right? So you had this organic growth combined with macro fundamental, money tailwinds. I mean, that's just not gonna. If you didn't make money, there's so many people that are acting like they're smart. Like I've been saying, there's just not enough humility out there, because there's too many people that are taking credit for Facebook, and really it was just Facebook. Mark Zuckerberg's rich for a reason. He's, no matter the sharp elbows, whatever happened in the origin story, the point is the product was the growth hack. It wasn't anybody at the company. Everybody's taking credit for it because it's 15 years later, but the algorithm or whatever it was worked. And everybody got aboard that rocket ship, and now everybody's kind of rewriting history. And it was YouTube, Twitter. So So the thing that I would do the most is just make sure you want to do this, because you could get lucky around the timing of it, as I did. But I was super passionate about, as a non-tech person, about this. I had my own money. I had my own um, wins and losses. So I kind of eyes wide open went into this, and some good fortune. But like the intentions were always like, fuck, this is going to be a grind. I'm in it for the love of the game. And we grinded. Our first fund was 6 million. Second fund was 20 million. Our third fund was 40 million. Like, I don't know, like you kids today with your $50 million first funds. So I think, knowing what I know, then I wouldn't change anything. I think you have to do these things for the right reasons. If you're gonna get into something, it's gonna be for 10 years. So same with founders, same with investors, same with running a fund. You're not gonna learn anything in a year or two. So unless you're willing to do this stuff for 10 years, why are you even taking that first step?
Got it. No, I remember Howard. I was lucky. I was working with you at the time when you were raising Fund Three, and
Was it fund three? Was it fund three or fund two?
I
Fund
think it
three?
was. It could be
That was a hard raise. It was fund
late
three was
Fund
still a
Two
hard
and then
raise.
Fund Three.
Those were hard raises, because didn't, it's just the market hadn't yet started to get easy. But, it was just getting there. But with that third fund where we raised 40 million, we already had a track record and we still weren't just getting any respect. And it was tough, which led to all the mistakes from 2018 to 2022. It's just like it got too easy. And that's not reality either. So yeah, those were interesting times.
Got it. And yeah, so be do it for the right reasons. You have to be passionate about it. It's a long-term play, and then timing is something that you can't, time it. But if you do get lucky, be humble. It's not just because you were just super smart. You were able to get into, like you gave the example of Facebook, and so how it typically, one of the criterias or types of fund managers you like to back are operators and founders starting their own funds. And usually what we've seen is, when they're working at or when they're building, founders want them on their cap table, and then even VCs invite them because they will help founders with their company building experience. But when an operator transition into a full-time investor, it's a different game. Now you're actually competing with other VCs. Earlier, VCs were inviting you, so it's a different game altogether. And how do you evaluate that? Like, can that person be a professional investor?
I don't know. I mean, like I said, I don't. I'm biased because I guess I knew the markets a little bit, and I had great mentors, as luck would have it, in the era of the Super Angel, oh 07, oh 08, Jeff Clavier, Roger Ehrenberg, Fred Wilson. They were writing, Ed Sims. These were guys that were like way ahead of the game, and they were blogging for free. Now that's a commodity. Everybody has a blog. But back then, like there's no social networks yet. So you didn't know who was good. Like there's no traffic. It was just people were doing it for the love of the game. So they had to really resonate with you, but you didn't know if they were, you could only use your own instinct if they were popular. There's no way to really measure because there was no ranking system. So it was just different. The that's the big difference, I think, from today.
Got it. And Howard, where do you see venture in the next 5 years?
I mean, it's just a thing like stock picking. I think just going to be just ain't going away. People got a taste of the fever. That's it's we're definitely in a shrinkage, valuation shrinking, but it's a phenomenon like stock picking. People are going to want to do this forever and ever, and there's all this there's definitely a joy of that people get from doing it, but it's kind of a privilege and not a right. So I think, I think people have to pick their right mentors, and they have to educate themselves on how markets work. And like I said, I think people need to learn to be price makers, not price takers. And that comes from experience. That comes from studying the masters and studying the math of portfolio returns and waterfalls from cap tables and, common sense. And, and that just the basic fundamentals of investing have to come back into play.
Got it. And Howard, one last question before we jump into our final part. Um, when you're doing as an emerging fund manager, as you're building your funds, staying relevant or reinventing yourself is a big question. How have you done it for yourself, or what frameworks typically you would advise someone to have in mind?
I think that's a great question. I think it comes down to just I'm like born curious, like you are. When you got off your ass and got to the States, like 10, you hustled your way into things. So that meant more to me than any degree. The true hustle and passion for it. You just were there asking. You just stuck around the net, as I did with Fred Wilson and Roger Ehrenberger back in the day. So I think, for me, it's lucky that I'm curious. So I have these different passions, whether it's cycling, or fitness, or tennis, or golf, or content and media. It's definitely, it's not all it's cracked up to be, but I don't know if there's another way to be successful unless you're like a mad genius. And I'm definitely not a mad genius. So I think the curiosities kind of come in. The curiosity has kind of been the difference.
Got it. So curiosity is the key. It leads you to all the right directions.
Yeah, I mean, if you're not curious, it's just unfortunate.
Yeah.
But it's a self-picking thing. Like you reinvent yourself by being passionate. And if you don't have curiosity and interest, it's just,
Yeah.
you're not gonna see things that other people see.
Yeah. Got it. And Howard, so as I introduced you to my co-pilot earlier, he is restless, and so he doesn't ask questions directly to the guest. He would ask me to ask the guest. He never spoke, by the way, but I'm waiting. Maybe one day, just out of nowhere, speaks. But Howard, what are you most obsessed about outside of work these days?
Just the not working. That's what I'm most obsessed about. But yet I just keep working. So I'm obsessed about the idea of not working.
Yeah. And how are you working towards that?
That would look like. I don't know what it looks like, but the idea of this life, I call it the degenerate and LVMH economy, is this, this fascination with what is work. In a world where people don't go into an office even at a young age in their 20s, their first job. Like, what is the definition of work and productivity and job satisfaction? And I don't know what work means. So, when I started out working, you had to put on a tie and a suit, and you had to dress for 4 different seasons. So it was expensive just the idea of work was expensive, because you weren't getting paid a lot and you had to wear a uniform. Now there's no rules of what is work. So that is fascinating.
And Howard, what's your day like? A typical day?
This is it. Just 10 podcasts.
Yeah.
Yeah. A typical day is, wake up very early, write, 1 cup of coffee, some fitness, Generally, when I'm working in a rhythm, I don't eat until about noon. It's kind of like a morning fast. And, I'm a PST guy, so I'm up 5 a.m. And so generally a few hours break in the middle of the day. And then, I generally leave my schedule open and best pitch gets into my time. And I don't have an assistant, so I try and have no schedule for each day other than maybe an hour or two, and it gets filled up. The magic is it gets filled up. I just don't know how to teach that to other people because that is not something that I recommend. Highly motivated to fill my calendar, and most people, if they have an empty calendar, it stays empty. So I don't know that part. But so generally, it's like 5 a.m. to 6 p.m. with a couple hours off.
Got it. And Howard,
Phone calls, writing, networking, and helping their companies.
what's the most undesirable part of your day?
Sleeping. It's a curse. Not because I don't want to sleep, because I can't. So
Yeah.
it's knowing that sleep is ahead is always a curse.
Yeah. How are you sleeping?
Terribly.
Yeah.
The drug enabled. It's the same as the old days. It's just one of those things. I was always wired not a good sleeper, and I think that's some people are just meant to be on,
Yeah.
and I've managed that, but it'd be fun to be a sleeper. I've never met an unhappy healthy sleeper.
And Howard, what's your relationship with health?
It's love hate. It is like it's part of this lifestyle thing. It's like I think it's because you have so much free time. It's a curse because there's so much food in abundance
Yeah.
around, and there's so much health and fitness and stuff coming at you of what's the proper way to eat, dress, how much exercise. So I think it's like a perfect storm of around health and confusion. But so I think it's a mystery that in America it's obvious we're being poisoned, but I know we're being poisoned because it's very hard to get off sugar and it's very hard to eat clean. And by eating clean, meaning you just feel better if you eat clean, but it's so hard to eat clean because we're surrounded by just junk. So it's a fascination for sure.
Yeah.
Yeah.
Did you try playing pickleball yet?
Yeah, I think it's fun. My son likes it. It's just not interesting to me. And with my joints and my age, it's a little bit like squash, and so it's a little bit more like jerky kind of movement. And I prefer low impact type fitness. At my age, I'm not looking to like beat anybody. I'm just more me against the mountain or me against time.
Yeah.
Is kind of my thing.
Yeah. So you're gonna keep it at cycling and golf. And
Yeah.
Howard, you've been blogging for many, many years now. And what's
Yeah.
something, a benefit that you got out of it that you had not expected? Later on, you sort of realized.
It's I say it's like banking. I was never a good saver of money, which is a curse. Like I think, if you don't write and you don't save money, you're kind of fucked. So if you can write and save money, you're ahead of the game because they're both deposits in some way. If you're writing, you're making deposits either to help yourself or in a social world, in a mobile world, you can be read by others. So I'm constantly surprised by who reads me. That's kind of I'm kind of always surprised whether I was in south of France and somebody in Monaco invited me somewhere, some big shot. And it's just fun. They'd never said hello until I was actually in Monaco, but they caught me. So that's fun. I think the random serendipitous people that know who you are, even though I'm not famous or trying to be famous. I'm just doing it because I like writing and sharing my ideas. So that's always the best part. Hard to, that's, there is no other upside to it. So there's all these, everybody should write. You shouldn't write unless, you're into the idea of like really long dated options on like upside, because there's just no immediate satisfaction from doing it. And that's kind of like saving $1 a day or $2 a day, or, there is no immediate upside, you know. So so I think those are two really good habits, again, along with curiosity, that at least I had two of them. I'm not a good saver. I always was trusting that I would be able to earn more than I spent. Um, but I always had the instinct to just put stuff to share. And sharing is almost as good. Maybe it's better than saving.
Yeah, got
And I
it.
think sharing is kind of made up for saving on my behalf.
So you do it for the love of writing, just love writing, and then byproduct is just serendipity and other opportunities that come your way. And
Yeah.
how one last one, if you could invite three people to a dinner table, dead or alive, who would they be and why?
I was going to kick with when I have, because you don't know, but just with my kids at a dinner table, like, just the random things that you learn from them over time, especially when they were even younger, because they were more open. They just didn't know what they were saying. It was always just, if you could get them going. But I think, other people outside the family, it would probably be, comedians. It would be Jerry Seinfeld, David Letterman, Larry David, maybe Gary Shandling, people that I idolized because of their craft, that you know that I think would be fun to be able to try and converse with them and make them laugh, and just see if I could hang with those people would be fun.
Got it. That's a natural extension of who you are. You love art and comedy, and Howie, thank you so much for doing it. I had so much fun. I really appreciate you for making the time for this.
You got it, and I'm sure we'll talk to you soon.